Forecasting involves estimating your revenue through solid market research. Never assume, never guess, do your research. Hi, I'm Joelle Foster. In this video, we're going to be looking at forecasting your financials. I'd like to take this opportunity to thank the Government of Manitoba for funding this video series. Sales are a challenging thing to wrap your head around when you're planning a business. It might seem like a guessing game, but there's more to it than random numbers.
At a fundamental level, you're trying to predict how much product you'll be selling in a given month, and then calculating your annual expected revenue. Essentially, when you have a number of products to sell, you can take their average price, calculate your sales for a given month, and then multiply by 12 to get your annual revenue, roughly. Let's take a better look at this using our Jen's Bakery case study. Let's crunch the numbers. Basically, Jen's Bakery sells 3 types of products. Jen has established price points for each of these. Her market research tells her that selling $120 per month of her product line is a safe assumption. This information allows her to work out her average monthly revenue. Next, multiply your average monthly revenue by 12, and you get a rough sales forecast of your annual revenue. However, this assumes that Jen's Bakery will make constant sales, month in and month out. Actually, it's your market research that will dictate why you think you'll be making a certain number of sales each month. So long as you have justifications for those assumptions, your business plan should reflect that. Jen's research tells her that her sales for her type of business show a seasonal pattern. During spring, she estimates she will sell 460 items. During the summer, sales should climb a bit higher at 540 items sold. In the fall, she expects her sales will drop to 320 items sold. Sales patterns are higher during the winter, and she expects to sell 600 items. Now, let's add up our annual revenues. Issues like problems with your supplier or seasonal highs and lows should be considered when charting out your sales forecast. Every industry is different, so make sure you know how yours works.
I forecasted my sales during my business planning. Based on being a hairstylist, I figured out a monthly projection for sales and services for myself and the other hairstylists.
I got on with a few Manitoba home builders who had repeat business for me. This allowed me to accurately forecast my sales, and then I included that in my business plan and was able to meet my goals.
So now you understand how sales forecasting is looking at your potential market based on your research and calculating how many sales you'll make. This will calculate your potential profit. Calculating whether your business breaks even is a simple formula.
Essentially, you'll take your sales forecast for the year and subtract your expenses for running your business. Let's take a look at this in the context of Jen's Bakery. Recall that we worked out our annual revenue to be roughly $28,800 using our assumptions that were based on our market research. Now let's calculate our expenses. Based on the same sales assumptions, we can work out our expenses for each of the seasons. These are our average cost of goods, the raw materials we use to make our products, the costs of producing our products. And these numbers are the overhead costs, the cost of doing business in our bakery. Next, we work out all of our totals per season, here, and add them together to get the total annual expenses for Jen's Bakery. At this point, we can finish calculating our business revenues. We take our forecasted revenues and subtract our forecasted expenses. If you end up with a positive number, this is the case here, congratulations, you've made a profit. This additional money could be reinvested back into your business, or paid out to the owners of the company or the stakeholders. On the other hand, if you end up with a negative number, like we are showing here, you've incurred a loss. You'll either have to figure out how to reduce your costs, perhaps by lowering your overhead, or raise your prices to generate enough income to cover this shortfall. Doing these calculations as part of your planning means you won't be surprised at the end of the year. You'll also need to keep a close eye on these numbers as you run your business, in case your costs change.
A key component to understanding your sales and cash flow is understanding the accounts receivable and accounts payable processes. Essentially, you're not always going to have cash in your bank account immediately after a sale.
Accounts payable are an amount a company owes because it has purchased goods or services from a supplier or vendor on credit. Accounts receivable are the amounts a company has the right to collect because it has sold goods or services to a customer on credit. Always remember, accounts payables are liabilities and account receivables are assets. The key is to learn to keep current and accurate records. Let's assume that Company A sells merchandise to Company B on credit. Perhaps the invoice states that the amount is due in 30 days. Company A will record a sale and also record an accounts receivable. Company B will record the purchase, perhaps as inventory, and will also record an accounts payable. Bottom line, your accountant will appreciate accurate record keeping. If this is not your thing, hire someone to do it. Do what you do best. Sell, sell, sell. I always say, he who has the cash is king. So make sure to get cash up front for your products or services. Until you have full payment on a product in your business bank account, this sale remains a liability, not an asset. I always recommend outsourcing to a collection agency. Trying to get money from your customers is a full-time job in itself. You have more important things to do. Spend your time concentrating on your business.
Although this planning can be daunting, it's always exciting to make that first sale. So, David, you've had a lot of experience in sales. Can you give us a little bit of your history?
My father opened his first ladies' clothing store in 1961 in Portage la Prairie. And I would go to the store after school and they'd put me to work. So I started working when I was 6 years old.
Wow.
I started selling when I was about 12 years old. I worked with my father until 1989. Then I went to work for Sands Stores as a ladies' wear buyer. I was there for 10 years. And then after that, I went to work for Nygaard from 99 to 2007. So I have an extensive background in sales, in marketing, and also in designing.
What was it like making your first sale as an entrepreneur?
Well, I had gone to the optometrist's office for an eye exam. And I was talking to the girls in the office, explaining what I did. And they asked me to bring some product down. I did some demonstrations and sold them some product. It was phenomenal because I didn't expect to make a sale. In the past, I had sold a product at a kiosk in a shopping center. And it's the hardest way to sell the product because you have to engage people as they're walking by. There's 200 or 300 stores that they can shop in. And you have to actually pull them in, with your sales pitch. The most important thing is to engage the customer, and the experience that they have with our product, the demonstration. That is what sells the product. It's not the product, it's the experience.
When did you start making a profit in your business?
We just started our business in June, and we don't plan to make a profit in the first year. There's a lot of expenses, there's a lot of equipment to buy, so it is not planned to make a profit your first year. We will make a profit in year 2.
David, what are some final words of wisdom that you would like to share with our entrepreneurs out there?
The most important thing is that you are your brand. Represent your brand professionally 24/7. Know your customer, but most of all, be passionate. If you don't believe in your product or service, nobody else will.
So here is your call to action. When you're working on your financials, you'll need to maximize your revenue and minimize your costs. Do your research and forecasting before you open your doors. Anticipate your leaner months. Manage your accounts receivable and your accounts payable. This way you'll always have cash on hand for those unexpected events. Being an entrepreneur is not just about having a great idea or a new product. It's about managing your operations on a daily basis.